Good morning, everybody. It is the last day of May 31st, 2019, and stock market is down again. We talked about this over the last 6 or 7 weeks that kind of expected May to be a tough month, and President Trump has helped out with that. Although I think a lot of what's going on is, the market just breathing a little bit after that really nice first 4 months of the year run up. And now we have to take account of some certain things. So I have a couple of articles that I wrote this week. We introduced the Dividend 30, and I want to talk about where I came up with these stocks and where we're going next. These are a type of dividend growth stocks. This really is called the Dividend Growth 30. But I can't change it on Seeking Alpha anymore, so that's fine. But the Dividend Growth 30, and the operative word there is growth. For people who are longer-term investors, who are actually looking for capital appreciation as well as the dividend income to add to your total return, you want dividend growth. And a lot of people who are dividend investors aren't dividend growth investors. They are just more dividend stability investors. These are retired people generally, or people making mistakes, people who are looking for 4 or 5% per year income. Here's the problem with most people who invest for 4 or 5% per year income, is that they are taking way more risk than they think they are taking. And that is why I look at dividends differently than I think most other people do. Most people are chasing yield. One of the top services over at Seeking Alpha and some of the other top services out there, they pitch how much yield that they can get you. Well, the problem with that is that companies that have high debt or no growth typically cannot sustain those yields, those dividend payments long term. And a lot of folks don't take into account the risk that they're taking in many dividend stocks. I would say that fully 1/3, and it might be higher if we have more than, if we have another financial crisis, it would be more. But in a garden variety recession, about 1/3 of the dividend paying stocks on the stock market are highly vulnerable to dividend cuts. And if they get dividend cuts, what's the next thing that crashes? Be their share price. So we have to be very careful not to invest in companies just because, hey, look, it's got an 8% yield. A lot of times, whether it's an MLP or a REIT or just a stock, they don't have the real underlying business to support that long term. So the two lists that I'm building are the Dividend Growth 30, and all of these companies have a growth rate that should not only support their current dividend, but should allow them to grow their dividend over time. The other list that we're going to build, and actually almost everything on the new spreadsheet is done, except I can't figure out the code for sucking in the dividends. We have a retiree low volatility dividend. Not done. See the empty spaces. I've got about 15 more companies to add there. So this is the list that I put on Seeking Alpha. What folks for free don't get on Seeking Alpha, and I'm not going to scroll through this, I don't want to show everything, is they don't get the support levels that are good spots to buy. But I do want to show you something here, and I'm leaving the screen a little bit blurry, so this isn't going to be very high resolution. I want it to be tough for people to copy. If you're a member, go ahead and log in. But this first support level really is generally a pretty good support level, but you don't want to buy it while the market's going down. So if the market's going down, think of the zigzag down. You don't want to buy the first support level. Not on the first go through, right? On the heading down part, don't buy. You can always buy on the way back up. And then you're getting something that's rising rather than falling. And the reason you don't buy the first support levels while the market is falling, the proverbial falling knife, is because you might get to a bottom fishing price. So when the stock market's going up, you can buy these support levels on the pullbacks, right? So these are the buy the dips within a larger rising trend. Right now, the stock market for 6-7 weeks now has been falling. And I don't know how long that will last. Anybody who tells you how long that will last is lying to you. But the best technical guys that I know really are taking a look at 3 spots. And the first spot was the 200-day moving average on the S&P 500. And we're not going to hold that. So at the end of the day, on the weekly chart, we'll be below the 200-day moving average. And unless there's a pretty violent rally up next week to break that trend, we would expect that we'd head down to the next support level, which is somewhere in the 2600s. It's always fudgeable intraday. So we want to be very defensive in the short term. There is a possibility that we have more than a run-of-the-mill correction down into the 2600s. We could go as far down as the December lows, which would be another 100 points or so. The reason I don't think that's going to happen is I don't see the trade tensions getting much worse short term, but we won't know that until the end of June. So you may want to maintain your cautious posture. And there's not hedge funds selling or people liquidating for tax losses at the end of the year like there was in December. So one of the reasons, 2 of the reasons that the market tanked so hard in December is that there was piling on by tax loss sellers and hedge fund selling. We don't have that right now. So somewhere in the 2600s seems like a pretty good bottom here. And the technical guys that I'm watching and listening to, the ones that I trust the most, are saying somewhere in the mid 2600s, 2625, I think is a number that I've seen, somewhere in the 2600s. So the S&P 500 drops another 100 points or so. You really want to start taking a look at this list here and saying, okay, what do I want to add to my portfolio, or what do I want to start new? Again, we could see the December lows. If we see the December lows, it's probably on some sort of news, probably related to trade, because that's what's got everybody up in a tizzy. And we might even see the 2200s or 2300 on the S&P 500 if this trade war really gets further out of control. Based on what's happened in the past week, that might happen. We've discussed the trade issues over and over again, and I don't think that the approach that President Trump is taking really stands much chance of being successful. That doesn't mean that I don't think there aren't issues out there to be dealt with. I think a lot of people understand what issues have to be dealt with. Bernie Sanders understands a lot of the issues that have to be dealt with. That doesn't mean that I like his solutions. President Trump can see that there's problems out there. That doesn't mean that I like his solutions. And I think that the markets as a whole, as a big conglomerate of people, giant voting machine, are showing right now that most people don't like what the president is doing, especially given that China is starting to ramp up some countermeasures. Now, if China really does withhold rare earths, metals, then we've got a problem, because we don't have our own processing right now. We got rid of our processing in the 1990s. And while we did open the California mine that produces a lot of the rare earth metals, we don't have the ability to process them. And it would take about a year to get processing capabilities up and running. Probably want to put, 2, maybe 3 processing facilities in the country. Maybe we get by with 1. There is a proposal to open 1 up. The quickest that would happen would be 6 to 9 months. So we have to take a look at what the stockpiles are of already processed rare earths, because otherwise our technology companies could really get hit hard. And that actually is an opportunity for us. If in the short term the technology companies get beat up even worse, these are companies that you have to buy, because in the long term they have the highest growth rates, they have the best free cash flow, they have the least amount of debt, and they are the ones who, they're the ones who are leading the way on the smart everything world, on IoT, AI, everything else. So when you take a look at technology, I want you to get over your view, if you have it, that, well, I don't want to be overweight in technology because technology is volatile. Technology impacts every single sector of the economy. So if you want to be diversified, invest in technology companies that impact various parts of the economy. So when you take a look at certain companies, they might impact AI. Other companies are more part of edge computing or 5G or something like that. So there's different segments of technology, and they impact different industries differently. So I would take a look at that when you consider technology. In my opinion, technology should probably be around half of your portfolio at the end of the day, because it's been the best sector for a very long time. And on the rare occasions that there's a pullback, and usually it's a big pullback, it's a great opportunity to enter. So keep that in mind. We probably want to add a lot of technology. Industrials and consumer discretionary have also been very good over the long haul. So when you take a look at this list, I was criticized for having too much technology on it. But when you take a look at the cash flow these companies are pumping out, they are more likely to support and raise their dividends over time and see their share prices go up as well. And one thing to keep in mind, if you have an IRA and you're a retiree, it doesn't matter if you sell a couple of shares to get your income or if you collect dividend, right? So if you're a do-it-yourself investor, but you want to set it and forget it, then you shouldn't be a do-it-yourself investor. If you can't go to your portfolio once a week and say, okay, I'm going to need a little extra income this month, maybe I'll trim a couple things that are overbought to make sure that my monthly distribution is fulfilled. And you should have, 3, 4, 5, 6 months of cash for your planned distributions in your account anyway. Then again, you shouldn't be managing your own money. If you can't take a look at it every week, set it and forget it is usually going to backfire on you, because you'll end up owning too many of those companies that are going to cut their dividend during the next recession. So these are all companies that will be pretty insulated from not only share price decreases, but the odds of any of these companies cutting their dividends is almost zero. So I did only include one consumer discretionary stock, but that doesn't mean that we don't have a lot of consumer discretionary direction. Apple, right, technology company, but really very hinged to consumer discretionary. Again, I go back to the point, technology impacts a lot of different things. One of the real estate trusts, have you ever heard of Gulf Galaxy? So EPR Properties has a lot of entertainment properties. So this is a way of getting involved with consumer discretionary, but through a REIT, which pays a big fat dividend and owns the underlying real estate assets as its backstop. So, we could go out and buy stocks in restaurants or parks or whatever. But these guys really are, to me, a consumer discretionary play. Disney also is listed as communication, but again, largely consumer discretionary, subscription services, and then the parks. So we do have quite an exposure to consumer discretionary, even though by sector, it doesn't look that way. Industrials have been a top half performer among sectors long term. And as we talked about in one of the articles, Zacks has done some interesting research which shows that if you only invest in the top half of sectors out there, you are going to beat the market by up to 80%. I mean, that's huge. So if the market averaged 10% over a decade and you consistently were in the top half of the sectors, you could make up to up to 18% on average. Now, you probably won't because you won't be perfect. However, just by dramatically underweighting sectors that aren't going to do well and overweighting the other sectors, in particular technology, but also industrials and maybe a little real estate, you should be able to beat the market pretty handily. One of the things I would encourage you to do, and I'll write an article about this, is look at the sectors of the economy. Okay, we've put up the S&P 500 chart before, and say, okay, let's create three categories. Sectors that will outperform most likely the index, do better than the index. Sectors that'll probably do about what the index does, and sectors that almost certainly or have a high likelihood of trailing the index. That last basket, the sectors that are likely to trail the index, don't invest in those. So if you only invest in the 6 or 7 sectors that are remaining, you are very heavily skewing your portfolio towards sectors that will either perform in line with the economy, with the stock market index, or outperform. So you just want to really whittle off the places with the most risk, like healthcare, and these sectors that never ever grow and really never ever beat the index except when the index is down, like consumer staples. One reason I don't invest in consumer staples hardly ever is, and if I do, it's Johnson & Johnson, which isn't technically a consumer staple, but to me it is, because that's half of their business, is that if we think the market's going down, we just want to get out. We don't want to invest in something, oh, well, the stock market's going to drop 30% here. I'm going to invest in something that will only go down 20%. Hold cash. You're better off holding cash. So when you take a look at your asset allocation, in April, we said, let's go pretty heavy in cash. That was an April 9th article. So from here on out, the spreadsheet will have this, and I'm going to, when it's time to put in a new one, we'll just push this down, and that way you can track the history of the asset allocation suggestions. I have a couple others that I'll probably put in here from old articles, just so you can see. But when we talk about asset allocation, again, if you're not going to be an active trader, like at fundamental trends, you may be swing trading a little bit more, but at margin of safety investing, you probably aren't. Mainly because I'm not talking about those trades at margin of safety investing. But most institutions rotate their asset allocation between 2 and 8 times per year, with 4 being the average. That means you sell off to higher percentage of cash, or you rotate to different industries. Institutions do it about 4 times per year. It's not a quarterly thing. They do it based on pricing. So that's the way we'll do it as well. Now, when they make shifts, because they have such huge asset bases, they might only tweak their portfolio by 20 to 35% of the assets moving, and usually that number is much closer to 20. For us, We may not make any asset allocation changes in a year, but up to 8. I can't really see doing more than 8, but maybe there's a year where we do 10 or 12, but you really only should have to tweak your asset allocation between 0 and 8 times a year. Now, we're lucky. We have tax deferred accounts, and we're not going to move the markets. When we make trades, it's not going to affect anything. So we can move 50 to 75% of our portfolio if we need to. And that's something that we almost did down here. We were down to 15% cash, 10 or 15% cash the whole first quarter. So we jumped big into the cash bucket. Why didn't we do bonds? Because corporate bonds have quite a bit of risk right now. International bonds have quite a bit of risk. And we probably should have invested in TLT because that rallied substantially. But there's what's called alligator jaws on one of the charts right now. So the government bonds are probably done or very close to being done rallying. So we just held cash. If interest rates were 2 points higher and we thought things were going to go bad and we were going to get a big rally in bonds, then we could do it. But interest rates have already contracted quite a bit. There's not a lot of upside left in government bonds. So our defensive posture was to hold a lot of cash. So with this dividend growth portfolio, I'd really be looking at these tech companies. You should probably at some point own almost all of them. Yeah. And again, most people aren't going to own 30 stocks. If you have a portfolio over about $250,000, maybe closer to $500,000, you're probably going to own 30 stocks. But if you're in the 5 figures or just in the very low 6 figures, you're building up to a 30 stock portfolio. Why a 30 stock portfolio? At about 30 stocks, if you have a couple of international ETFs in there and a couple of international stocks as well, that's really all the diversification you need. Now, especially if you include 1 or 2 domestic ETFs. Ultimately, if you have exposure to over 200 stocks globally, you cannot reduce your risk anymore. So somewhere between 30 exposure to 30-ish stocks if you want to be really concentrated, not have ETFs on top of that, and 200 stock exposure via the ETFs in your own holdings is where you're going to be. So let's suppose you own the NASDAQ 100 ETF, QQQ, and then you buy 20 stocks. Now you're exposed to, somewhere between 110 and 120 stocks, depending on what your overlap is with the QQQ. That's a pretty good portfolio, especially if you do something along the lines of 20% in QQQ, say another 20% in international. We're not quite there right now. So say even 10% international, but 20% is a better long-term number. And then you have 60% of your money in 20 or 30 stocks. That's a pretty good portfolio. The other ETF that I'm starting to really like are the ARC ETFs. And again, those are actively managed ETFs. But I really like how Kathy Wood manages that money. I think she might be one of the best managers out there. I know some of you don't like her largest holding, Tesla. So don't invest in the ARC ETFs if you don't like Tesla. But there are good ETFs out there to give you exposure to the maximum diversification you need, which is around 200 stocks globally, about 2/3 to 3/4 of those American, and then the balance would be international. So we're never going to get the asset allocation perfect, but if all of a sudden you see that between your ETFs and your stock holdings, you own 350 stocks, exposure to 350 stocks or 500 or 600, good for you, but it's not any safer than 200. and it has less upside. So what you really want is for maximum diversification, exposure to, and this is from studies, to about 200 stocks globally. Again, about 3/4 American, 1/4 international, maybe, right in there, give or take. And, if you want to be more concentrated, which means you're looking for more upside, then you whittle that back to maybe 100, stocks total exposure, 120, give or take. For most folks, I don't think most folks have the risk tolerance to only be exposed to just 30 stocks and no ETFs. But if you do, just understand how much risk you're taking. The folks who should, and if there's any millennials listening, the folks who should be invested in just a handful of stocks in their personal portfolios are the millennials. So let's suppose you're a millennial and you have a 401k with $30,000, $40,000, $50,000 in it, whatever. Basically you're indexing in your 401k or using these asset allocations that I have. You really shouldn't ever buy another ETF or mutual fund outside of your 401k. At a young age, save money in a Roth IRA or a personal account as much as you can, and buy 1 or 2 or 3 or 4 stocks a year, and that's it. So, keep that in mind. I'm going to have a report out there on how millennials can build $1 million plus portfolios pretty quickly, over 10, 15 years, just by investing $500 a month. And folks who invest $500 a month for over a decade, and you're buying 2, 3, 4 stocks a year, you're generally going to do pretty good. Just as a buy and hold investor, very, very infrequent portfolio changes or asset allocation changes. As far as the stocks on this list go, you can read the article. The criteria were pretty tight, and I've spent about probably 6 months now researching all of these companies. So I'll be putting reports out on all of these companies over the summer. And some of these companies, Dave and Ted have already talked about. I'll talk about them more, do some quick thoughts. But you'll notice the whole smart everything theme. That really is the way everything is going. And to not be exposed to industries that are either creating that environment or benefiting from that environment. Remember, there's a lot of industries that do well with better technology. So the industrial companies are, I think, some of the ones to keep an eye on. In particular, I'm not always a cat guy. I haven't been in Caterpillar for a while, but I will tell you, if Caterpillar crashes on this trade war down into the 60s or 70s, you probably want to buy it. Because in the electric vehicle era, which, we're in the first inning of, we're going to need a lot more metals. And whether that's lithium or zinc or copper or some combination of all of the above, Caterpillar is going to be the company that gets that. The other thing is, ultimately, with agriculture, we're going to have to find a way to take land that's not arable right now and make it arable. Because as the human population goes up, there's only 2 ways to grow. We can have greenhouses everywhere, which I think is coming too, or we can take some of the land, and we lose 3-4% of our land every year that's arable, which means that in like 50 years, we'd be out. We have to protect our arable land, and heavy machinery, especially the kind that you can operate with a joystick from a drone, using a drone, are the machines of the future. So I like CAT if it really does one of these giant dips down into the 60s. Would I buy it up here right around 100? I don't know. Maybe if the market's turning around, but I want to get to the edges. So I'm generally going to try to eye the bottom fishing, especially in a market that's declining, right? And I think over the next 18 months, the market will be choppy to down. I think that there's probably a rally here coming soon. And then you get one of these fall off a cliff events where there's kind of a trap door under the market. That could actually be happening now. If we wake up on Monday and the S&P 500 is down 100 points, there you go. The trade war is no joke anymore. My belief that there was going to be positive surprises, I'm at the coin flip stage right now. I have no idea if the Chinese are willing to deal with us. They are so pissed off that, if you read their press, which is basically a mouthpiece for the government, they are so pissed off at this point that, the scenarios that I talked about a month or two ago, where they just kept stretching things out and then ultimately said they'd be willing, they might say they're willing to withstand a shallow recession, which would be horrible for our economy at this point. Just to get rid of Trump, President Trump. I think you could see the Chinese do the opposite of what the Russians did. So we'll see. If you want to read more about what I'm thinking is going to happen, you can read the Get Ready to Buy Stocks Soon. And, again, you have to consider your risk tolerance. I think there's going to be a rally, but ultimately I think next year is a down year. So if you just don't want to deal with making those trades, well, one, I don't understand why you're subscribed. But I think there's a rally coming. You can use the chart to do that. And then you'll have to sell again in the first quarter next year. I think that's the way it's going to go down. But again, don't buy at these support levels while the market's still going down. You'll get a second chance, right, when the market comes back up. All right, why don't we take questions? Somebody asked me who my technical guy is. I've got about a dozen of them. So I won't worry too much about that. There's lots of them. I cross-check them to see if somebody says something real interesting. A couple of you post stuff from one of those guys on the chat room once in a while. This list, if you go to the, Avi's in the dozen, but he's not the guy. I think Avi's very good for market analysis. He doesn't even pretend to analyze stocks. I have a typo. Somebody says I have a typo. 60. 65. I'll double check that. This one's probably 5. But let's see here. Stocks. Core mining, that's a junior miner. That's just a matter of, when silver and gold prices go up, they'll do well. And they have lead. I mean, for them, their execution story as much as a price of metal story. They just have to execute at their silver tip mine. Folks a lot of times ask the wrong questions, I think, is, what about the price of oil to an oil stock? What about the price of gold to gold stocks? Those companies are leveraged to the prices, yes. However, for most companies, it comes down to execution. Are they creating free cash flow? So that's really what you want to take a look at. The natural gas stocks that we're invested in, which are mainly Antero and Chesapeake, they're getting the shit kicked out of them just like all the energy stocks. Are we really so far along in the paradigm shift towards alternative energy that these companies should be getting traded like they're going out of business? I don't think so. I mean, I'm a guy who's been an oil and gas guy for 20 years, and I'm telling you that the end is coming for those industries. And I'm probably more aggressive in my estimates, right? I'm saying around 2030 is when a lot of shit hits the fan for those companies. But the the sell-off they're getting now is largely Norway driven. Norway is selling $7.5 billion worth of E&P stocks. And then you have negative momentum. And then you have a thin market to begin. And you've got millennials who index and the traders who see the weakness, so they pile on. And what we saw in the last couple of weeks is that the hedge funds were starting to bet on oil and gas stocks going up a couple months ago, and they've bailed out on that now. So they've cut, I think it was like a third of their positions or long positions. That's one reason to read what's the one? Value Walk. You know, you read Value Walk, and I've got a discount code for you. If you read Value Walk, then you see what the hedge funds are doing, and that's pretty important information. I tell you what, if you haven't subscribed to Value Walk for $90 a year or whatever it is, you need to subscribe to Value Walk. I'll put the codes up on all the websites again and in my Twitter feed. Value Walk is such an invaluable tool for so cheap that I don't know why anybody wouldn't have that one. Devon Energy just sold their Canada operations, which we knew was coming. Well, they get almost around $3 billion or $3.8 billion, $2.8 billion. I don't know. It was a lot of money. They're pretty much putting it all towards debt reduction, which is the smart thing to do. We don't want the oil companies to produce more oil. We want them to keep producing what they're producing, stop increasing production, and pound down debt, pay out dividends, and buy back shares. That's what we want. And in fact, I'm going to write an article that if you're an owner of gas and oil stocks, you need to start pounding on those executives to stop drilling more for the sake of drilling more. We don't have any shortages of oil and gas, probably never, ever will. So as an investor, we need a stable price of oil and a stable price of gas that are at higher spots than they are now, because otherwise those companies do go out of business. You know, we just saw a bankruptcy, some little company. A lot of the little wildcat companies are about to go under. So we'll see how that goes. And the story is the same for all the oil and gas companies. All the oil and gas companies we follow are basically producing free cash flow and starting to produce more free cash flow, even at oil prices around 60. I can't tell you when people are going to wake up to the fact that these companies are doing well. Now, there was a study by Hard Energy and by, I think it was Norway, that only between 10 and 20% of the companies are producing free cash flow. I've told you that. I showed you screening charts where we really don't want that XOP after the next rally. We only want to own specific companies that are at the top end of the free cash flow, scale. And we want the companies that are going to merge or be bought. And, if they get bought, they get a premium. If they merge, they create synergies and get even more free cash flow. So we've only really targeted a dozen of the 68 or whatever it is E&P companies out there, right? It's not the whole group that we want in the long term or even in the intermediate term. In the short term, you can own XOP, but that is the first thing to sell on a rally. We probably should have sold it when it was 35 and just said enough is enough. Now we have to wait for it to get into the 30s again. Will it get to 40? If there's a wave of mergers and acquisitions, if there's a war in the Middle East, there's a lot of reasons why it can spike, but it probably wouldn't stay there. So if there's a spike, you'll want to sell it. It's the same for all of them. Encana, Devon, all of them. All the companies, same story, merger and acquisition candidates, starting to produce more free cash flow, exposure to the Permian. It's the same thing for all of them. And then CenturyLink, They have a super valuable asset in their networks. The level 3 acquisition was transformative. People aren't seeing it that way. But the fiber optic network they have, they can start charging more for. And ultimately, CenturyLink is just going to say, you know what? You guys are still using our network, and this is what you're paying. You're going to pay more because there isn't an alternative. It's not cheap to put satellites up in the air that are going to be in such a great network that they can take over the telecommunications. The networks that are going up in the sky are for specific purposes, and Facebook has problems of its own. It's not going to be launching anything soon. Google has special purposes. I still think Google, it makes a ton of sense for them to buy CenturyLink or spin out their fiber company and buy CenturyLink. So we'll see. But at some point, the reason I'm high on the telecoms is, one, they're all beat to hell. And two, they all have valuable assets that in a connected world, they can charge more for. AT&T's already started doing it. I'm telling you, Verizon and CenturyLink and AT&T and maybe Comcast, the places where you get your internet from are going to start charging you more for that access. It doesn't make any sense why they wouldn't. There's limited competition. And even with 5G, how many of us are not going to have some sort of wire into the house? Right? Because what would be the next thing? If everybody starts going to purely wireless using 5G, what do those carriers do? They raise your price. Why? Because we've only got 2 national carriers right now, 2 kind ofs, and the 2 kind ofs are merging, but the Trump administration has no idea how telecom works. So they're getting in the way of that too. Now, ideally, there should be 4 national 5G carriers. I've talked about this in the past. The only way for that to happen is for there to be mergers among the regional companies. I think that U.S. Cellular is the company that should get bought by somebody. Either by that, there's a group of companies on the East Coast that are all under one umbrella but with different names. They should buy U.S. Cellular. Or if the Trump administration says no to T-Mobile Sprint, then one of them should get in bed with U.S. Cellular because they got the middle of the country covered pretty good. So we'll see. Newmont Mining. I don't think our calls are anywhere close to getting called away on that, are they? Those were $34, $35 calls. Newmont Mining is like 32, isn't it? Take a look here. Oh, wow, they could get called away. Well, then you live with that big fat dividend and that small profit on the stock. Oh yeah, that's right. We rolled the calls super in the money. Yeah, that's fine. It's a profitable trade. And if you want to really own Newmont long term, I would just sell puts. Sell $31, $30 puts if you want. On the next dip. Gold is up today. I was just putting money in Newmont because I saw that we could make 10% in 2 months between the option premium and the special dividend on the merger. So, we could always just get back in there. I mean, volatility gives you lots of opportunities. I know that it makes people's stomachs churn, but if you wait for the edges, right? If you wait for the edges, you're usually going to figure out ways to make money. And the reason, again, this is all these stocks have growth rates at least 4% per year, but most of them are 8, 9, 10, 12, 15%. A lot of tech names are 20%. So you have growth rates on all these companies between 4 and 20-something%. A couple of the materials companies aren't growing right now. But an alternative way to look at it is, are their assets undervalued? And a lot of these companies' assets are super high, undervalued. Yeah. So like the company that just got mentioned is Marin Software. We started buying a small position in that company. It's a micro cap. It's a nano cap stock. We can move the stock price by buying it, so I'm very careful not to pump it. They're offering shares, which people look at as negative, but the reality is they're starting to create a market. And I've seen this happen with small nano caps, micro caps that turned into small caps, that turned into mid caps. They have to create enough of a market. And with the insiders owning so many shares, there were just limited shares to go around. So when we tried to buy literally 1,000 shares or 2,000 shares, it drove the stock price up 5%. So, like Marin is a company that I think is, it got down to that bottom point. They said around 3 was the bottom. It's a little under that now. I think that you can nibble in on that. And don't go nuts. Don't make it more than 1 or 2% of your portfolio. But that's a stock that's in the right place at the right time, given the types of regulation that I see coming to the internet. So Google, Facebook, Amazon, Facebook in particular, like I said, I know that Dave likes them, but I think they have big problems coming because they're not going to be able to sell data anymore. I mean, brokering data is going to become very, very tight. So that means profit margins are going to go down dramatically for companies that rely on brokering your data. Opting out, you probably see across your browser screen all the time now when you go to a website. They're putting up their cookie policy right away. But if you don't agree to their cookie policy, you still get to use the website. I mean, understand that not agreeing to somebody's cookie policy, they usually still let you use the website, right? But they're trying to get you to agree to sell your data. That's what they're trying to get you to do. So you should probably say no to every single one of those cookies until you start not being able to use the website, because your browser will save your passwords. You don't need the cookies on your computer. In fact, everybody should go clear their cookies now, clear your cache, everything back in time. And, make sure you know your passwords if you're not using Chrome to save them, or, if you're not saving your passwords in your browser, you make a list, right? Because about 20, 30 people on Fundamental Trends did not remember their passwords and reset it so many times that they got frozen and I had to reset it. I know that you all get as angry as I do when your passwords don't work. So, but you really can just tell all the cookie pop-ups, no, I don't want no cookies. And think of it as an internet diet, right? I don't want no cookies. And unless they're going to block you from using their website, it doesn't matter, right? So just make sure you save your usernames and passwords. All right, I think we're going to call it. Have a nice weekend. Dashlane for passwords. Yeah, maybe. I don't use that. I just use my browsers and then I back them up. Yeah. I will have the retiree low volume dividend list out about June 10th. I will have the growth 30 out middle of next week. These are companies that are for sure on it, the ones that are left on the spreadsheet that you can see. And the other thing about the spreadsheet is once it's complete, I'm going to restrict it. It's not going to be just published to the web anymore, and you'll have to request access. So I would think that if you don't have a Google account, you probably want one. Gmail is the best email system out there of the free ones. They do filtering, and you almost never get spam. So I don't know that that's required when you request a share. You just have to have a Google account. I don't think you necessarily have to use Gmail. But you'll need that, and that'll give you access to manipulate this however you want to manipulate it. You won't be able to touch my copy, but you can adjust your copy. All right. And as we talked about all the energy companies, let's keep an eye on the market next week. If there's good news on trade, I think Alibaba, tell you what, Alibaba is getting super attractive right now. We talked about how they're going to expand into the cloud. They're already the #1 cloud service in the Far East, in Southeast Asia. I don't know if Alibaba can do what Amazon did, but that's how they're set up. I don't know how the numbers will shake out in the long run, but they're set up to basically go through a huge growth phase the way that Amazon did. Does that make this a $1,500 stock? I don't know, but I would bet that Alibaba is trading 400, 500, 600 several years out. So I think Alibaba, if you want China exposure, is going to be one that you have to add. This will actually get put on a different list. I'm going to have a international growth list. International growth. Here, we can do that right now. No, it's already there. Oh, now I have to put in more lines. Oh, well. But I think Alibaba is one of the stocks that you have to have at some point. And you know that I don't like investing in China stocks, but I think this is a must-own. So, all right, have a great weekend. Enjoy some, a lot of growth. Yeah, exactly. Somebody just said something about Alibaba, and they're right. I'm going to put out an article about how to use the support levels and the bottom feeding, just because I know that people get confused, and then we have new members, right? So I will try to get the video up around market close. All right, have a great weekend, everybody.